Have you ever seen the headlines about a company and wondered what's really going on? Well, today we're going to pull back the curtain and look at a company's financial report. And don't worry, it's not nearly as complicated as it looks. It's actually a story, just told with numbers, and we're going to learn how to read it.
Okay, so you look at something like this. This is a real financial statement from United Breweries. And yeah, at first glance, it can just look like a giant, intimidating wall of numbers. But I want you to think about it differently. It's really just a company's report card. It tells us exactly how they did, no fluff.
And the best way to get it is to break it down to something we all understand, a personal budget, right? You've got money coming in, money going out, and then what you have left over at the end. We're going to use that exact same simple idea to follow the money and see what story this report card is telling us.
All right, let's get into it. First things first, we'll start right at the very top. Let's see how much money actually came in the door.
So this first key number you'll see is called revenue from operations. Now, you'll hear people in the business world call this the top line. It's basically the total amount of money they made from selling their stuff. Sticking with our budget analogy, think of this like your gross salary, before they take out taxes or anything else. It's that big starting number.
And here it is for United Breweries. For this 3-month period, they brought in nearly 4 lakhs in revenue. So that's our starting point. That's all the cash that came in from their sales.
But here's a super important point. A number by itself is kinda useless. You need context. You need to compare it to something. So what we do is look at the same 3 months from the previous year. And what do we see? A clear, healthy increase. Now that tells us something. That is a really positive side.
Okay, so we've got the money in part figured out. Now for part 2 of our budget, where did all that money go? Let's take a look at the expenses. This chart is a great way to see it. It breaks down their biggest costs visually. And right away, 2 things really jump out. The biggest piece is costs of materials, what it actually costs them to make their product. And then there's this other huge chunk called excise duty. So what in the world is that? Well, excise duty is a specific kind of tax placed on goods that are produced and sold within a country. And for industries like alcohol or tobacco, this tax is often really high, which makes it a massive expense for these companies. So you take the cost of all the raw materials. You add that hefty tax bill. You add what they pay their employees and all the other day-to-day costs. You add all of that up, and there you have it, the company's total expenses for the quarter.
Okay, here we go. This is the big one. We know the money that came in, we know the money that went out. Now it's the moment of truth. Did the company actually make any money? The formula here is about as simple as it gets, but it is the absolute heart of any business. You take your total income, you subtract your total expenses, and whatever is left over, that's your profit. You'll often hear this called the bottom line.
So let's see how this works out for our company. We start with that total income number, we take away all those expenses we just calculated, and we're left with a profit for the quarter, a little over 8,100 lakhs.
And this is where that comparison becomes so powerful again. Not only was the company profitable, but look at this. Its profit almost doubled compared to the same time last year. Now that is the kind of growth that really gets investors paying attention.
So the main story is clear, right? Sales are up and profits are way up. But, if we want to dig just a little deeper, these financial statements can tell us even more. For instance, we can look at the segment information. This table shows us exactly where that money came from. And while they do sell some non-alcoholic drinks, you can see the vast majority of their revenue, it comes from their core business, selling beer.
Another number investors absolutely love to look at is something called earnings per share, or just EPS. It sounds fancy, but the idea is simple. You take the company's total profit and divide it by the number of shares of stock that exist. It's a quick way to see how much profit is being generated for each individual share.
For this quarter, United Breweries' basic EPS was 3 rupees and 6 paisa. It's just another piece of the puzzle that helps us get a complete picture of the company's financial health.
So what's the key takeaway here? It's that these documents, they aren't just for accountants. They are narratives. They tell a very real story about a company's successes, its challenges, and its strategy, all written in the universal language of numbers.
Okay, Picture this. You're standing in a hospital room and you're looking at a heartbeat monitor. For months, the pulse is just getting weaker.
Right.
You know, it's beep, pause, beep, pause. It's drifting down, fading. It looks pretty grim.
It looks really grim.
And then, bam, suddenly, right at the end of the tape, the line just shoots vertical. It's like the patient didn't just wake up.
Oh.
They woke up and started sprinting a 100-meter dash down the hallway.
That is a very dramatic image, but, looking at the source material we have today, it's surprisingly accurate. We're looking at a chart that seemed dead on arrival a month ago and is now just screaming with life.
Exactly. We're looking at a stock chart for UBL, United Breweries Ltd, on the National Stock Exchange. And this isn't just a spreadsheet of numbers or, some quarterly report.
No, it's a story.
It's a visual story of a massive crash and a really, really aggressive, almost violent recovery.
It's the classic V-shaped recovery, or at least the very beginning of one. And those are so rare because they require a total instantaneous flip in market psychology.
So, our mission today is to decode the technical signals hidden right here in this specific daily candlestick chart. We're looking at the Nuvama platform view.
Right.
And we are not guessing based on news rumors or beer sales or management changes. We are strictly reading the heartbeat of the stock.
Through price action, volume, and the indicators.
Yeah.
Which is, frankly, often more honest than the news anyway.
Price pays.
Price pays.
Right. So, for context, let's get you oriented. We're looking at a time frame that runs from late August 2025 all the way through to where we are now in February 2026. And the current status, that little blinking cursor on the screen, shows the price sitting at 1628.70.
And that number, 1628.70, it represents the equilibrium point of a massive battle happening right now between the bulls and the bears.
So whether you're a seasoned trader who, dreams in Fibonacci retracements, or you're just someone who sees these charts and wonders, what do all those green and red squiggles actually mean? We're going to break it down. We've got the price action itself. We've got these weird bands wrapping around the candles, and then the engine room indicators down at the bottom.
Let's start with the dominant narrative first, which is the fall. You can't really understand the recovery if you don't understand the crash that came before it.
Let's do it. Because looking at the left side of this chart, say around August, September 2025, UBL was living the good life.
It was.
Trading up in the 1800s, it looked stable.
It looked deceptively stable. But if you zoom in on the center of the chart, moving into October and November, the whole character of the stock changes.
How so?
The market structure shifts. We start seeing that classic pattern of lower highs and lower lows.
Okay, unpack that for us. What does that actually look like for someone, holding the stock?
Well, you think of a ball bouncing down a staircase. The ball drops, it hits a step, and it bounces up a little bit. But that bounce, the high, is lower than the previous bounce. That's a lower high. It means the buyers are getting exhausted earlier and earlier. They just can't push the price back up to where it was.
And the lower low is just the ball hitting the next step down on the staircase.
Exactly. Every time it falls deeper than the last time. It's the textbook definition of a downtrend. It tells you that sentiment is shifting from buy the dip to sell the rally.
So every time the stock tries to breathe, someone just smacks it back down.
Precisely. And then, come November, December, the ball stops bouncing and it just rolls right off the edge. The angle of the decline gets much, much steeper.
Yeah, that is a cliff.
That's the acceleration phase. You can see the candles, those red rectangles showing the down days. They're getting longer, more frequent. That drop from December into January is just brutal. It goes from around 1600 straight down into the 1350 range.
1350? That looks like the floor. Why did it stop there?
Well, that's usually what we call the capitulation point. It's the moment where everyone who was just thinking about selling finally panics and sells all at once.
Maximum fear.
Maximum fear. And once there are no sellers left, the price has nowhere to go but up.
Which brings us to the hockey stick. Because if you look at late January, early February 2026, the far right of the chart, it's like gravity just got turned off.
It is a violent reversal.
Yeah.
They're not seeing a slow, rounded bottom where the stock gradually builds confidence.
No.
This is a spike. The price just rockets from those lows around 1350 back up into the 1600s in, a matter of days.
It's practically vertical. But I want to pause here and really zoom in on today, the current candle. Because while the trend looks like a rocket ship, today's specific data It tells a slightly different story.
It does. It's telling a micro story of struggle within that macro trend.
So let's look at the data header. We have an open of 1655.0, a high of 1657.90, a low of 1610.50, and the current price is 1628.70. Okay, let's play detective. What do these four numbers tell you about the mood in the room right now?
Well, first, look at the open. 1655. That's a very optimistic start. The market opened much higher than where it's trading right now.
So there was enthusiasm at the opening bell.
A lot of it. People were putting in market orders to buy immediately. The fear of missing out crowd showed up for breakfast.
And they pushed it up even further to that high of 1657.0.
They did. But, and this is the crucial part, they couldn't hold the line.
Because the current price is back down at 1628.7.
Exactly. So from the high of roughly 1658, the price has been pushed down about 30 points. That tells us that when the price got that high, sellers stepped in.
They said, okay, this is expensive enough, I'm cashing out.
That's the signal. So visually, on the chart, this creates what chartists call a wick, right? That thin little line sticking out of the top of the candle.
Right.
A long upper wick is basically a map of failed conquest. It's the territory the bulls captured in the morning.
But the bears reclaimed by the afternoon.
Yes. It's a sign of rejection.
But it's not a total disaster, is it? I mean,
No.
the low was 1610.50, and we're trading above that.
True. We're not at the lows of the day. But the fact that we are trading below the open means the candle body itself would be red. It indicates that despite this huge uptrend, the bears are actually winning today's specific skirmish.
It's like winning the war but losing the battle of the day.
That's a great way to put it. But to understand the war, we have to look at the battlefield map. And that's where those curved lines come in.
The green and red lines enveloping the price, these are the Bollinger Bands, right?
They are. And this is probably one of the most useful tools out there for understanding volatility.
To me, they look kind of like a riverbank that the price flows through.
That works. Or think of them as the guardrails on a highway. The middle line is the center of the road, a moving average. The upper and lower bands represent standard deviations.
Okay, standard deviations. Uh-oh, flashback to statistics class. Give us the explain like I'm 5 version.
Put simply, statistically, the price is supposed to stay between those guardrails about 95% of the time.
So it's an event when it touches one.
It's an event. When the price hits the bands, it's at a statistical extreme. When the car hits the guardrail, that is not normal driving.
Okay, so now look back at the crash in November and December. Notice where the candles were relative to those bands.
They were just glued to the bottom red line, just riding the rail all the way down.
That's called riding the bands or walking the bands. And a lot of beginners see the price hit that bottom band and they think, oh, it's at the bottom, I should buy because it's cheap.
And that is a very dangerous mistake.
Why? If it's at the statistical bottom, shouldn't it bounce?
Not when momentum is that strong. When the price hugs the lower band like that, it's a sign of incredibly strong bearish momentum. The selling pressure is so intense it keeps pushing the price to the edge of cheapness. And yet it keeps falling. It's not bouncing off the guardrail, it's bending it.
Bending the guardrail, that's a great visual, but now look at the right side, the breakout.
And here's where it gets fascinating. The price hasn't just touched the upper green band. It has pierced it. It punched right through the guardrail and is now driving off-road.
Is that good or bad? Driving off-road usually ends in a ditch.
It implies extreme volatility. When a candle closes above the upper Bollinger Band, it's a signal of immense strength. The bulls are incredibly powerful, but it's also an overextended state. It's like a rubber band that has been stretched to its absolute limit.
And I noticed the bands themselves are doing something interesting. Back in September, they were kind of narrow. Now, they're gaping wide open.
That is the expansion. Bollinger Bands measure volatility. When the market is quiet, the bands squeeze tight. When the market explodes like it is now, the bands expand. It tells us the market has woken up. It's a high-energy, high-stakes environment.
So we have a price that's screaming upwards, breaking all the speed limits, but every car needs an engine.
Right.
We need to know if there's actual fuel behind this move.
The engine room.
That brings us to the bottom panels. Let's start with the very bottom graph, the vertical bars. This is volume, correct?
Yes. Volume is the number of shares being traded. I always call it the truth serum of the market.
Why truth serum? Can't you fake volume?
Not really. You can manipulate price with a small order in a thin market. You can paint the tape, as they say, but you cannot fake volume. Volume shows you if the big institutions, the whales, the mutual funds, are participating. It costs millions of dollars to create those tall volume bars.
So looking at the volume bars during this recent spike, they look like skyscrapers compared to the rest of the chart.
They do. Look at that cluster of tall green bars on the far right, matching the price jump. Now, compare that to the volume back in October during the consolidation.
Yeah, back in October, it looks like a freshly mowed lawn. Very low, even bars. Now it's a Manhattan skyline.
That tells us that this move from 1350 to 1628 is not a ghost move. There is significant money changing hands. This is what we call volume confirmation. Price is up, volume is up. The trend is healthy.
Okay, so the car is speeding and the tank is full. But there's one more gauge on the dashboard, the RSI.
The Relative Strength Index.
Yeah.
The panel just below the main price chart, labeled RSI 14.
And it's just a single white line wiggling up and down. Break this down for us. How do we read this speedometer?
Think of RSI as measuring the speed of the price change. It goes from 0 to 100. The classic textbook rules are below 30, the stock is oversold.
Fallen too far too fast.
Right. And above 70, it's overbought. It's gone up too far too fast.
So trace the journey for us. Where was the RSI in January?
In January, at the bottom of the crash, that white line was deep in the basement. It was well below 30. That signaled the panic selling had probably gone too far.
And now?
Now, look at it. It's almost a vertical line shooting straight up. It's approaching, or has probably already entered, that overbought zone near 70 or 80.
So wait, if it's overbought, does that mean we should sell? That sounds like a warning light to me.
And this is the single most common trap for new traders. They see RSI hit 70 and they immediately sell everything or even short to stock.
And then they get run over.
Often, yes. In a really strong trend, a stock can stay overbought for a long, long time. You can sit at 80 or 90 while the price keeps climbing. Overbought doesn't mean sell now. It means momentum is incredibly strong, but be careful. The engine is running hot.
Okay, so let's try to synthesize all of this. We have a lot of signals firing off at once.
It is a cacophony of signals, yeah.
On one hand, you have the bull case. The trend has clearly reversed. We have massive volume. We've got momentum breaking through upper barriers. The patient is definitely alive and sprinting.
Absolutely. The lower highs and lower lows pattern is broken. That's the most important structural change. The long-term trend is trying to shift to up.
But then we have the bear case, or at least the caution case.
Correct, and that comes right back to today's specific candle. Remember the wick.
The rejection at 1657.90.
The price tried to push higher today, and the market said, nope.
Not yet.
Not yet. Combine that with the fact that we're statistically overextended outside the Bollinger Band RSI sky high, and it suggests we might be due for a cool down.
A cool down doesn't necessarily mean a crash, though.
No, not at all. It could just mean the price moves sideways for a week. It could mean it dips slightly to let the moving averages catch up. It's like the runner stopping to catch their breath after a sprint.
So if you're looking at this chart, you're seeing a battle between the fear of missing out, driving the price up, and the fear of heights kicking in at these exact levels.
That's the dynamic. The volume shows the fear of missing out, people are rushing in. But the wick shows the fear of heights, people are starting to get dizzy up here at 1650.
Well, 1650 specifically, is there some magic to that number?
Look back at the chart. Look at October. Where was the price trading just before the big crash started?
It was bouncing around. Yeah, right around 1650 to 1700.
That's called overhead resistance. Imagine you bought UBL back in October at 1650. Then you just had to sit there and watch it crash all the way to 1350.
You feel terrible.
You'd feel terrible. You'd feel regret. You probably promised yourself, if this thing ever gets back to what I paid for it, I am selling immediately.
And now, suddenly, here it is. It's back at 1650.
And what do? You sell. You say, thank goodness I'm at a break even. That creates a huge wave of selling pressure from the bag holders of the past. That's what explains the wick.
That is the human element right there. Just get me out of break even.
And the bulls have to chew through all of those sell orders to push the price higher. That's why volume is so important. It takes a lot of energy to absorb that supply from the regretful buyers of last year.
Fascinating. It really is just a map of regret and relief.
Markets are nothing but efficient mechanisms for transferring regret and relief between strangers.
I think I need that on a t-shirt. Let's bring this back for the listener. If I'm looking at this UBL chart, what's the big picture takeaway?
The big picture is that UBL has successfully defended against a major collapse. The drop to 1350 was a serious threat, and the buyers stepped up in a major, major way.
The trend has shifted.
The trend has shifted. But the immediate short-term signal, that daily candle we see right now, is waving a yellow flag.
A yellow flag, not red, not green. Just proceed with caution.
Exactly. The easy money from the absolute bottom has been made. Now comes the hard work of proving if this new price level is actually sustainable.
That's a key distinction. The bounce is the easy part. The sustain is the hard part.
Smart money usually waits for a pullback here. They want to see if the price can hold 1,600 or maybe 1,580. If it pulls back and then bounces from there, that confirms the new trend is real.
And if it just crashes back through 1,500...
Then the V-shape fails, and we're back in trouble. But the volume, those skyscrapers, suggests that there are real buyers here now who want to defend this price.
All right, let's wrap this up. We've looked at the UBL chart on the Nuvama platform. We've seen the plunge from the 1800s, the dark days of December, and the glorious resurrection in February.
We've seen the RSI overheat and the Bollinger Bands burst wide open.
And we've seen that today, right now, at 1628.70, the market is taking a moment to decide what happens next. The engine is hot, the car is moving fast, but there's a speed bump just ahead.
A speed bump? Or maybe just a rest stop. But the chart tells us the momentum is undeniable.
It's a classic example of why you can't just look at the price. You have to look at the context of the price.
Yes.
1628 on the way down feels very different from 1628 on the way up.
Context is everything in technical analysis.
So here's a provocative thought to leave you with. We often think of a stock spiking vertically as a sign of strength. We see green, we see up, and we think good. But when you see a chart pierce the upper Bollinger Band while the RSI is going vertical, is that really strength? Or is it a climax? Is it the grand finale of the fireworks show right before the sky goes dark again? The chart shows the jump, but that little wick on top of today's candle whispers that the ceiling might be a lot closer than it looks.
Sobering thought. Gravity is always waiting.
On that note, thanks for diving deep with us. Keep